Hello, I'm Mitch Goldberg. Thank you so much for joining us. This is my live stream, Be the Boss of Your Money, all about personal finance, all about helping you to gain the skills and knowledge so that you could take control of your personal finance. We're doing something a little different today. I have a very special guest, Charles Freeman, Chartered Financial Analyst, Chief Investment Officer, and RIA Principal for the AdaptFirst Advisor Cooperative. If I may add, he happens to be one of the smartest people I've gotten to know in the world of finance, and it is my pleasure to bring him onto the show. I'm going to hit him up with lots of questions. Hopefully I'll get him with some zingers. But the best part is, if you're watching this in the live, ask Charles questions in the comments. If you're watching this in the replay, welcome to you as well. And certainly I would love to see your questions here as well, and we will both see those. So I'm going to roll the intro, and then we're bringing Charles on. Here we go. Hey, Charles, thank you so much for joining me today. I really appreciate your time. Thank you.
Hey, Mitch. Glad to be here. Thanks so much for having me.
You're very welcome. And to everybody watching, I appreciate your time as well. You chose to spend some of it with us. That means a lot to both of us. So, Charles, you are a Chartered Financial Analyst, Chief Investment Officer, RIA Principal at the AdaptFirst Advisor Cooperative. You've got some credentials, but more importantly, you are one very smart fellow. And I really enjoyed getting to know you, and I've enjoyed getting to see your content and your thoughts about all things investing, markets, Fed policy, etc. So let's kick it off with this. Where are we in the cycle right now, in the economic cycle?
A lot of people think that we are actually starting a new, bull cycle. Obviously COVID crushed a lot of industries, and I would almost argue that we're not actually. I think we're actually probably in still a continuation from sort of pre-COVID, so I question whether or not we're at the beginning of a new economic cycle myself. So.
That's a good way to look at it. It's very interesting. A lot of people think it's a new cycle. It's we've had a sort of a reset, but I could see how this is just a continuation because we went through, as far as the stock market goes, that was over so quickly. It's hard to even think that it was anything more than a brief interruption, kind of like the crash of '87. In a way, if I could find some history to relate this to. The economy took longer to recover, but in my opinion, the recovery right now is booming. ISM numbers, employment figures, industrial manufacturing, you name it. It seems like the economy is really running just in a boom right now. Does that make sense to you, or am I overly optimistic?
Well, no, I think it makes sense because we're actually starting back up, right? Literally when COVID happened, it was like somebody turned the light switch off and, said, go sit at home for a few months. And it was really difficult to sort of see what the impact of that was going to be. Well, now, people that I've talked to, they were talking about how things kind of shut down and now that things are reopening back up, it's crazy because a lot of people are trying to play catch up. From where, they had missed orders and things like that. So I think it's really just kind of this seesaw action of sort of everything stopping and then now everything's starting again. And so when you look at year over year numbers, it gets all wonky. But yeah, so I think it makes total sense.
I wish I put this on the screen. It's probably not too late, but I don't want to bore people with the going back and forth. But I was on the TSA website last night. I know it's just, when you're bored, you've got nothing to do, and you're looking for something fun to do. You go on the TSA website to check out passengers traveling. And about a year ago, today is the 7th, but April 5th was the bottom, 108,000 travelers compared to 2 million some odd travelers the year before. But now we're about 1.3, 1.4 million travelers per day via air in the United States. And it just looks like it's only increasing. Boeing got a big order over 100 or about 100 MAX jets from Southwest Airlines. I see manufacturing continuing to boom, but how long does this go on for?
I think with all of the, the stimulus is sort of being pumped in. It'll be interesting to see that. At first, I think we're getting, back up, trying to get back where we were. So a lot of companies and industries, like I said, are sort of ramping back up. And then you certainly have a lot of other industries on the leisure side that still have a long way to go. So they're catching back up too. But, I think with some of the plans that the government has, with, kind of the infrastructure things they're talking about, there's some industries that could, see this run, much farther. So, yeah, I could see it continuing, going forward with all the money that's floating around.
Well, the infrastructure is supposed to be a 10-year plan. And we all know that there's no such thing as really shovel-ready projects. Things have to go into the drawing board, and it takes a long time to make things happen and to disperse this much money. It's not like stimulus checks where they go out and it hits the economy immediately. It takes a while to get infrastructure going, to make changes. But I think that's more to the bullish side that, we go from recovery, and then the recovery is pretty quick and it starts to slow down, but still in an upward trend. And then we call that an economic expansion. It's really tough for me to see anything that could ruin the expansion in the horizon, except for one thing. But before I say what I think it is, what do you think could knock this market and economy into reverse?
To me, the thing that I've kind of gone back to for a while now is inflation, and I don't know if that's what you were thinking as well.
That is what I was going to say.
Yeah, I've been looking at it for a couple of years now, and it's really, that just is sort of the singular thing that I keep coming back to is really the only thing that derails the Fed from what they're doing. The only thing that could really probably impact consumer spending, I think substantially, and is you start to see an increase in inflation. So, and we haven't seen that right in like 40 years. So I think there's a lot of reasons why that could impact, the economy and behavior, and certainly investment markets going forward.
What areas, if we do see inflation, do you think would benefit in terms of investment possibilities?
I think that one of the things I'm looking at is if we start to see more inflation, more in house staples is going to do in that situation, because at the end of the day, there's a lot of things that you have to buy, right? And so even if prices are going up, you're still going to be buying, toilet paper and things like that. So,
toilet paper and toothpaste. Yep.
Kind of wonder how, those areas. And also, you could kind of think about, again, sort of alcohol, tobacco companies. And actually, I think the legal cannabis industry is going to boom over the next 10 years. So, I almost see
that's very interesting.
Yeah, industries like that, to where, that people, they're going to be willing and readily paying up for, to keep, they want those items, I guess.
Well, I guess if we have high inflation, as Warren Buffett calls it, the misery index, if that goes up, people are going to want to drink more beer and inhale more THC.
Right. Right. Exactly.
Except this time the THC will be legal and there'll be some tax collection from it as well. And everyone who's watching, if you have any questions for Charles, ask away. He can literally answer anything, and he is by far and away, I have to say, I think he's the smartest person I follow on LinkedIn. The reason I say on LinkedIn is because I'm connected with thousands of people, and I love to see Charles' content, and I often actually look forward to seeing your content. We have one person out there, a friend of mine, and that is Gary. Hi, Mitch. As always, I can't miss your broadcast. You are amazing. Well, you are amazing, and thank you very much. You made my day. That is that's a special thing. I should take a screenshot of this. Let's take a screenshot of this moment right here. Okay. We're going to take a screenshot. Something I've never done before on the live stream. Okay. Smile. Okay. We'll see how that looks in a social media post. Thank you very much, Gary. Really appreciate that. Do you think the Federal Reserve is making a mistake by being so committed to staying low for long and to its bond buying program? It's QE4, whatever you want to call it.
I mean, I think there is a high probability for a policy error. I posted a while back. It's almost like the opposite of what Volcker was doing. Back in the late 70s and 80s. I mean, he was basically saying, I'm willing to sacrifice employment to get a handle on inflation, and we've literally come, sort of full circle where, Powell was like, basically saying he doesn't care about inflation for to get the employment back. So I mean, is that right or wrong? I mean, I think that I think it makes sense that a lot of people have kind of made comments on some of my posts about that. I don't think that the government should be involved, and that's not actually the case. I mean, I definitely think there are times to where we need government support and involvement to help our economy recover. And I mean, and I think COVID was a great example of that. And even the 0809 crisis, where I had more of an issue is when things did start to normalize, like over the last 11 years, kind of pre-COVID, was that well, I should say the economy normalized, but monetary policy and stimulus never really normalized. So I mean, investors were becoming more and more dependent on this stimulus, and we're sort of going away from looking at company fundamentals and earnings and things like that to dictate prices. And I think when you start getting disconnects like that, that's when you start getting into asset bubbles and things like that, which ultimately can be very dangerous for a lot of people.
What was the reason given? The name evades me. When Lehman Brothers was let go, when they were allowed to fail, Paulson, Treasury Secretary Hank Paulson, said he didn't want to create, was it a moral obligation, an expectation that the Federal Reserve and the government will always bail out investors. If the term hits me again, I will just blurt it out, even if you're in the middle of a sentence. But I agree. I mean, it just seems that since 2008, we have been on some form of stimulus. It's the whole time, even when Jerome Powell tried to raise rates in late 2018. You remember the stock market, the S&P 500, which is an index. You can't invest directly into an index, but you could invest in a security or stock that tracks or mimics the index. Okay, you have to get that disclaimer in there. You say, "Oh, good, I do that." So what you have to, he tried to raise rates. He raised rates 3 times in late 2018. We saw the S&P 500 quickly correct 20%, and he had to just back off immediately and start cutting rates again.
See, and I think that's a great point, because that to me, the Fed's mandates are, controlling, prices and inflation, and trying to, get full employment. It's not about managing the stock market. And I mean, and I think that has actually what has evolved over the last, 10, 11 years. And I think that's where, again, like, I think policy mistakes could be important in thinking about, because that's not the Fed's mandate, is to manage the stock market, but that's essentially what it's turned into. And I don't, it's hard to know where that goes, but I mean, I think you can look at the recovery over the last year and basically see that investors are, it's like a cult, really. I mean, it's like there's a lot of Kool-Aid going around and it's being drunk.
I love, look, what's the Fed's job? To take the punch bowl away. So I think your Kool-Aid analogy is very cool. Okay. Excellent analogy. Listen, I don't want to interrupt the flow, but we've got a few people out here, a few friends, and this is just the best part. We enjoy this. Keith is out there. Hey, guys, just jumped on. Two of the smartest guys on LinkedIn. Wow. Thank you very much. I am definitely second place right now. That's for sure. And we have Nick out here, Nick Nielsen. Mitchell, just wanted to thank you for your show. You're such a shining star. You, my friend, are the shining star, and
Nick's the man.
He is a great communicator. I mean, he communicates with illustrations, and I know we're all pushing Nick to put all of his illustrations about personal finance into a book, and I can't wait for it to become a bestseller. So thank you very much. So I think the policy mistake that we talk about is the Fed says we have tools to deal with the economy if it runs too hot and if inflation gets too far above our target. And they're saying they'll allow inflation to run above their target 2% plus, a little over 2%. They'll let it go for a while because they'll average it in over many years, not just for one quarter. But the policy mistake is once inflation is out of the barn, then the course correction is jacking up interest rates, pulling back on the bond buying programs, tightening the money supply, crushing stocks, and hurting the economy. Is there any other way? Because I think all it takes is for the Fed to change course, and investors are going to run into, I don't want to say a panic, but I think that runs into a very ugly market because the expectations that the Fed stays loose through 2022 into 23 is so strong.
Right. Yeah. I mean, I think that's exactly right. I mean, I think investors, I mean, I've sort of described it in the past as like a drug addict, and it's like, I mean, they're so addicted to this sort of Fed activism that if it runs into a situation where investors feel like, the Fed is losing control of the situation and can't just sort of, have their hand on everything. I think that uncertainty is going to freak everybody out. And it's like, oh my God, maybe they're not going to be able to support us because even in a situation where, I don't think they're going to allow interest rates to kind of keep, if interest rates keeps pushing up because of all the stimulus, I think eventually we get like official yield curve control, but we could still see inflation keep going up and up. And if that forces them off of that, a policy, if they're sort of forced off of it, then I think that really shakes the confidence of investors. So that's what I mean. I agree. It could get really nasty, like really fast.
And that's the key. You said it. The Fed would have to be forced to abandon its policy because they stuck in their heels so deep that they can't turn around. You literally have to pull them out of whatever ditch they dug themselves into. Yeah. So when the sugar high wears off, we have to get another dose of sugar, and sugar, it's like a drug too in some ways. So let's change the subject a little bit because I really want to get to where are we going? What should we do next? I mean, from a personal financial advisor, what you do next is if your goals are coming up, your financial obligations are coming up, you start to take money off the table out of risky investments like stocks, and you put your investments into stable investments like money markets, CDs, savings accounts, cash equivalents, well in advance of the time you're going to need them. But people have made a lot of money in the market. There are an awful lot of people who are just really whistling past the graveyard. At what point do you start to say, enough is enough? I don't need to catch every nickel of upside in the market. I need to start protecting what I've made in this incredible bull run.
Mm-hmm. Well, I mean, I think that kind of goes back to, you know, the financial plan, right? And I think that it's really important to look at your return assumptions in the financial plan, especially now, because I mean, JP actually has a really good chart in their guide to the markets,
With
looking
JP
at,
Morgan. Mm-hmm.
yeah, JP Morgan,
Yep. The guide to
looking
the
at,
markets. Very
yeah,
popular. Mm-hmm.
yeah, forward returns and valuations. And I looked at the update the other day because the second quarter update was out, and it's basically at zero. I mean, so looking back historically, if you look at forward 5 year returns, where we are now from a valuation standpoint, I mean, the expected return
Not
after
looking so good.
is zero. So I mean, like, you know, you sort of look at that and you sort of factor that into your financial plan and say, okay, well, how do we reconcile this? And especially for clients that are at or near retirement or in the distribution phase, that's what a lot of people are really underestimating, is that if you're starting to pull money out now in retirement and you're thinking, you know, hey man, this market's rock and rolling, I can pull out 6%, you know, every year and I'm good. I think that if we do see this asset bubble pop, I mean, it could be a real problem. The sequence of returns risk right now is
Sky
real.
high.
I mean, it's really high, and I think it's really important to communicate that message to people, and make sure they're aware of kind of what's going on.
Right. And just so people know, if you haven't heard of the sequence of returns risk, that means that when the market's up and you need to take a certain dollar amount out of your investment portfolio to pay your financial obligations, you get to sell fewer shares because stocks are up. But if the market has a bad correction, you have to sell more shares to raise the same amount of money. But because you're selling more shares, you have fewer shares working for you in the market, so that when the recovery happens, you don't quite make it back. And then
Right.
you wind up with a deterioration in the value of your portfolio that actually could accelerate and happen a lot faster than you anticipated. Is that a good
Right.
way to describe it?
Yeah, it's exactly right. I mean, I think that you know, your probability, you know, with it, when you build out a financial plan, you can look at a Monte Carlo simulation to say, you know, what's your probability that you might run out of money based on where you are right now. And so it looks at all of these return assumptions, and what happens in especially if you start taking distributions at a market high, and we subsequently have a downturn. Not even, it doesn't even necessarily have to be a crash, but it could be you know, a downturn over the first few years that you're starting to pull money out. Then, to your point, like, even if the market corrects later and the market does come back, you know, those withdrawals exacerbate the negative returns.
Right. The most dangerous time for a negative sequence of returns is when you first retire.
That's right.
Yeah.
And so it really increases your chances that you could run out of money, assuming all else is equal. Right.
Okay. So I want to get to a couple of other areas that I've seen you cover. Okay. Let's talk about international investing. You just wrote something about international investing, and international investing has been basically dead money for 10, 11 years. It started to pick up late 2020, about, to the point now where people are making new entrants into, emerging markets, especially, are finally are making real money. Do you see that continuing? Is that a neglected asset class in people's portfolios?
I think it is actually. I mean, if you know, the post I was actually referring to another chart in the JP guide that I thought was really interesting. It was really illustrative of, so there is cycles of outperformance in the US versus the world, and then vice versa. And then if you look at those cycles, it actually is pretty highly correlated with what happens with the dollar. And like from 2001 to about 2010, the dollar was kind of trending down, and international really outperformed the U.S. during that time period, and emerging markets especially outperformed. And someone could argue, a lot of that was China's growth during that time, and I think that's fair. But even going back, JP actually ran it back, pretty far, and you see that sort of trend. Now, what happened is you saw the dollar kind of reverse and has really strengthened over the last decade as the U.S. really led the recovery out of the great financial crisis. And so the U.S. has just dominated over the last 10 years. And now what we see, and this happened last year, but the dollar kind of rolled over and sort of broke that 10-year trend line to the downside. And there's a lot of dollar bearishness out there, and so if that turns out to be legitimate and we do see a lot of downward pressure on the dollar, that could really affect and help international outperform on a relative basis the U.S. Over the next 5 years, because
right. Should that also help gold and oil?
It should, because declining
right? Weaker dollar.
Yeah, exactly.
Okay, and just want a quick hello out there. Then we're going to get into where we are going with this. James is out there. Thanks for sharing, guys. You're very welcome, sir. And James is also on LinkedIn. James Wrigley, Nick Nielsen, Keith Wilson. Everyone watching this, if you want to learn more about personal finance, follow James, follow Charles, because they are the best. They create educational content daily, not the kind of content that you scroll past. You stop scrolling and you think. And that's what I love about your content, Charles. You actually are one of the people that makes me stop and think. And that is something special. So let me ask you something else as far as oil goes. We have a surge in electric car, an expected surge in electric cars. The Chevy Silverado is electrified, 400 miles to a charge. But I still see energy as a very underrepresented part of people's portfolios. Where do you see energy heading, both as an investable sector to own, let's say, the XLE ETF as an example, or just in general as how it would affect the economy?
I mean, to be honest with you, I think the effects of fracking has really changed the dynamics of oil in relation to the world economy, on a permanent basis. I think that we're definitely seeing some, as we've sort of seen this sort of downturn and spike with COVID. I mean, there's some interest there, but longer term, I just have a really hard time seeing how you have sustainable, demand, especially like it was. I mean, we would call that a regime change, because once the fracking revolution kind of happened, I mean, and it sort of opened up all of these reserves that we never really knew we had.
And it's not just in the United States. There are actually fracking reserves all over the world.
All over the world, right? So I mean, you sort of had this global glut of oil. And so while you could have these sort of shorter term spikes in demand and things, I still don't think that, those broader supply demand issues are going to be prevalent. And with this increased focus on electric cars, I think that too is going to remove a lot of demand. And you also look at, China's making a push because of the pollution issues there. So I mean, China's the biggest car market in the world. So I mean, they're actually trying to make a push to be more
electrified.
And conscious of that because of the pollution situation. So I mean, I just think you have a large amount of demand, declining over time. It's not to say that you're not going to have, need oil for other industries, because there's absolutely, that is the case. So I don't see that going away permanently.
Look,
but I do.
The reason I ask is we've had oil shocks in the past, but it just, to me, it looks like unless we have a major oil shock sometime in the next 5 years, I think we're going to get to the point in about 5 to 10 years where oil shocks will really no longer be a part of anybody's equation.
Right.
Yeah, so that has broad ramifications for geopolitics. But I do want to ask you, I just want to touch upon this. I don't want to get into where you think we're going. We see some speculation. I call it speculative froth. Other people say this is where we should be going. And I don't want to paint everything with a broad brush, but I'm talking about SPACs and cryptocurrency. I don't think you could really talk about investing today without bringing those two subjects up. I see, to me, SPACs, every time a new SPAC comes out, it's a worse company because the best private companies are taken early, and it's the leftovers later in the cycle that are getting SPACed, if you will. And then Bitcoin keeps going up, and there are a number of CEOs who believe in it, a number of very smart people who believe in it. Mark Cuban, for example, Elon Musk, and others. So do you see those as a sign of speculation, as a warning, or do you see it just as, there's always speculation in markets somewhere, and this is just the speculation of the day?
I mean, I definitely think about on the SPAC side. I think that it's just a huge sign of this sort of excess, irrational exuberance, kind of whatever you want to call it. That's absolutely the case. On the crypto side, it's really interesting because I think Bitcoin has gotten more traction over the last year, especially because actually, to your point about the dollar, I mean, I think there's been questions about, going back and looking at what, the Fed is doing and, how is all of this going to affect the dollar, and can we trust central banks to really, be good stewards? I mean, because again, it's like on the one hand, everybody's sort of buying into what the Fed is doing, but then at the same time, there's a large group of people saying, hey, they're just a bunch of crazy people. We need to get away from this system.
It's actually making your assets worth less by printing more dollars, but you don't recognize it because the inflation, the asset inflation that it's causing, so you think you're getting richer.
Right.
That to me is one way to look at it. And I think there's just a clamoring for something that is finite, that can't be expanded. And that's why some people talk about going back to the gold standard, which I don't think that is a good idea either. But Keith is out there and he has a question. Charles, what are your thoughts regarding China creating digital currency? That's a tough one, but you know what? I think all of our opinions are valuable now because it is so fantasy right now, right?
Yeah.
But not fantasy. It's so speculative to even wonder what it's going to be like.
Right. Well, I think that I think it's just a matter of time before a country comes out with their own, digital currency. I actually talked with a guy in Japan not too long ago, and he said there are multiple countries that are working on digital currency. So it's already in the works. And I think that, the thing about China that's really interesting is because there's a belief by a lot of people that we're entering into this sort of second Cold War where, you got the US and you've got China, and there could literally be like two sort of separate economies going forward. So depending on how relations go, obviously, during Biden's
two internets, two economies, two sets of rules for banking and finance.
Right. So,
Sure.
and the reason why the dollar too has sort of, I think nobody questions its status as reserve currency. There's really been no other competitors, to the dollar. And so what would be really interesting if China does end up, going down this road. So, they're legitimately large enough that maybe they could be considered a competitor, and it's a digital currency too. Does that change the dynamics now? I think it's a really important issue, and
it bears watching.
Yeah,
it certainly bears watching.
Yeah, absolutely.
Okay, so where do you just last question forgetting about, well, if you need your money, it should be out of the market. If you don't need your money for the long term, it should be in the market. Putting that, it's tough to say this, but putting that aside, just looking at the stock market, looking at the economy, and realizing that they're not always the same thing. In fact, very often they're measuring two very different things.
Sure.
Where do you see us going over the next 6 to 12 months? Do you think this just continues right along, or do you think, like, you know what, we've probably pulled forward so much demand for paper assets, for real estate, and in the economy that you'd be lucky to just get, be flat for the next 6 to 12 months? What do you think?
Mm-hmm. I mean, I definitely think so from a return standpoint, I think there's we could potentially grind higher, right? Because where valuations are, they're just stupid high. And I mean, and I disagree with anybody who says that there are only, certain pockets of overvaluation. I mean, if you look at price to sales, which is the broadest measure, it's way higher than we were, back during the .com days. So,
Look,
I mean,
of the biggest companies that are publicly traded, what percentage of these companies don't even have earnings today? I think you would know that. Do you know that?
I don't know that offhand, but
20,
I do know that 26% of the Russell 3 are zombies that can't pay their interest
right.
payment.
So, I know I learned about this because I read it in your post on LinkedIn, but you post a lot on LinkedIn. But this is the gain, the benefit, the value I get out of knowing you from LinkedIn. So last thing I want to do this. I want to do a quick share screen.
Oh, okay.
It's the nicest thing I saw all day today. So I would just want to say how wonderful it is to virtually at least somewhat meet your mom and your grandmom, and that is just absolutely terrific. So that is great. I really I have to say I enjoyed that. Okay, that's the best post of the day. I want to thank you very much for joining me, Charles. As always, you are interesting to speak with. You are a great communicator. And if anyone is watching this, wants to reach out to Charles, please do so. He is a very welcoming, warm person. He's on LinkedIn, Charles Freeman, CFA. Charles, I'm going to let you go now. Thank you. And we will talk very soon. You've provided tons of value, and I really appreciate it.
Thanks, Mitch.
Okay, take care.
Thank you.
You bet. Okay, so the music is playing, which means it's time to go. Thank you so much, Charles. Thank you, all of you, for watching. I really appreciate it. And I'll see you tomorrow.